In November 2022, the world's second largest cryptocurrency exchange collapsed in 72 hours. $8 billion of customer money vanished. The founder was 30 years old. He had been playing League of Legends during board meetings. His name was Sam Bankman-Fried. Sam Bankman-Fried graduated from MIT in 2014. He took a job at Jane Street Capital, one of the most secretive, high-frequency trading firms on Wall Street. 3 years there taught him one thing better than anyone else his age: how to spot price differences between markets and exploit them before anyone else could react. In 2017, he left. He founded a trading firm called Alameda Research. The name sounded academic. The strategy was simple. Bitcoin was trading for thousands more in Japan than in the United States. So Alameda bought Bitcoin in America and sold it in Japan for a profit. At its peak, they were moving $25 million a day. By 2019, that opportunity was gone. So he made a bigger move. If crypto was the future, he didn't just want to trade on exchanges. He wanted to build the exchange. FTX launched in May 2019. It targeted professional traders with features competitors didn't offer: derivatives, margin trading, instant settlement. In just 18 months, FTX became the second largest crypto exchange in the world. On paper, he was worth $26 billion. He slept on a beanbag in the office, wore the same cargo shorts to every meeting, donated hundreds of millions to politics, and said he planned to give it all away. The public story was perfect. Effective altruism, earn to give, regulatory responsibility, testifying before Congress, celebrity endorsements: Tom Brady, Gisele Bündchen, Larry David, Shaquille O'Neal, a Super Bowl ad, a $135 million arena deal. But the private story was different. FTX and Alameda were supposed to be separate. That's what the public was told. In reality, Alameda had a line of credit from FTX, a line no other customer had. It eventually reached $65 billion. Alameda was using customer deposits to fund its trades. Customers thought their money was safe. It wasn't. It was being lent out without their knowledge to a hedge fund making increasingly aggressive bets. When those bets worked, Alameda made money. When they didn't, the money was already gone. By mid-2022, Alameda was in trouble. The crypto market crashed. Luna collapsed. Terra collapsed. Three Arrows Capital went bankrupt. Alameda had exposure to all of it. Billions tied up in failing bets. Illiquid tokens priced far above reality. The losses were real, and the money covering them was still moving. November 2nd, 2022. A leaked balance sheet changed everything. It showed that Alameda's biggest asset was FTT, a token created by FTX itself. They weren't holding real value. They were holding something they printed. The market noticed. 4 days later, Changpeng Zhao, CEO of Binance, spoke. Binance would sell all its FTT. That single move triggered a bank run. Customers rushed to withdraw. In 24 hours, $6 billion was requested. FTX didn't have it. It never had it. November 8th, withdrawals stopped. November 11th, bankruptcy. November 12th, remaining funds were hacked. Sam Bankman-Fried resigned the same day. What followed was surreal. He gave interviews, New York Times, Good Morning America. He apologized, said he didn't know, said he wasn't aware. At one point, he said, "Oops," but his inner circle told a different story. Caroline Ellison, Gary Wang, Nishad Singh, all pleaded guilty. All cooperated. All testified. He knew. December 12th, 2022, he was arrested. October 2023, the trial began. 4 weeks. The jury needed less than 5 hours. Guilty on all counts. March 2024, sentence delivered. 25 years in federal prison. Every collapse looks different on the surface. Enron hid losses off the books. Lehman buried them in financial structures. Madoff simply made the numbers up. FTX used customer money to cover losses in a company that wasn't supposed to be connected. The surface changes. The pattern does not. Every collapse starts the same way. Complexity no one can audit. Trust that replaces verification. And leverage that amplifies everything. FTX had all three. A structure too complex to follow. A founder people trusted instead of questioning. And leverage built on customer money. When the bets failed, there was no margin for error. This lesson isn't new. Enron taught it. Madoff taught it. And it will be taught again. When a company becomes too complex to understand, and trust replaces scrutiny, leverage becomes the only thing that matters. And leverage always finds its limit.